Let's welcome on board then Ravi Menon, analyst IT and technology India at Macquarie, joining in on the show right now to analyze what the earnings within the IT pack signify so far. Ravi, hi, morning. Good to have you on the show. And let's first start off with HCL Technologies because I don't think you can really pinpoint anything wrong. If nothing, they've actually upped the lower end of their guidance. Do you think that this seems like a sustainable performance to you?
Yeah, sure. So I think yes, definitely very broad-based. Across all segments have grown. The three segments: the IT and business services, the ER&D side, and the software products. All three, and all across verticals as well. And once you adjust for the State Street joint venture divestiture, BFSI also has shown good growth, more than 3% quarter on quarter. So overall, I'd say pretty credible performance. And on the margin side, that's actually I think where it's been really exceptional. We had been waiting for some good signs of margin improvement. And now, in their core segment, IT and business services, that's nearly 75% of the business, they have shown a margin improvement. And they've also talked about how from here, you shouldn't really look at headcount as a lead indicator for revenue growth. So that tells me that they have a lot of utilization headroom or what they think is productivity improvement that's possible within the current workforce. So I would expect that they can improve margins further. And the product portfolio, the software products, that of course has a lot of operating leverage. So if you see that continue to grow mid to high single digits as the company wants it to, that is a structural margin lever as well every year for HCL Tech. So I think these two are good rating triggers. One thing that people might wonder is why didn't they raise the high end of the guidance? I think that after FY23, where they actually came in October, raised the guidance, and then the environment changed suddenly and they missed by a whisker. I think that's why the management probably didn't do that.
Ravi, how much of this turn in business, which is contraction, has stopped, expansion has started, is already in the price? Because mind you, the stocks of HCL Tech or TCS or Infosys are not really far away from record highs. So our market's already pricing in a better 2025 and a decent FY26.
I don't think so, Nikunj, because if you look at it where they are, I'd say that if you look at the last 5-year average or the last 10-year average, right? There were a lot of factors that were weighing down the PE multiples. People are even concerned about the whole business model itself when, back in 2015 when Trump was about to enter office at that point. And we saw some higher visa rejection issues, stuff like that, because white collar unemployment was a problem back then. That's not an issue anymore in the US. So I don't think politics really matters as much, the US politics this time. The second aspect is, the visibility on growth. I think this was the first time, I think, post-COVID, we saw a couple of good years of growth. Now I think we actually will have 3 to 5 years of really strong growth. And I think that visibility should help, probably drive some more re-rating. I'm significantly ahead of consensus. I mean, for example, on a large cap stock like HCL Tech, I'm 4% ahead of consensus estimates on FY26 and 9% ahead on FY27. I think that we still have room for upgrades, and I think that means we should see multiples also move up. And even on fundamental basis, HCL, you look at it, they're converting 110 to 120% of their net income to cash flow. So you're looking at free cash flow yield of about 4% plus. So that's not bad. I mean, especially when you might see the US 10-year come down to 3%, over the next 1 year.
Okay. So for markets, do you think in FY26, and these are businesses which tend to often be cyclical because the base is there, when demand comes back, operating leverage kicks in. Are we in for a 10% kind of a growth in FY26? Is that what something markets are secretly betting on?
I don't think markets are, but I think that is possible. I think generally the consensus is still about 7-8%. We think that there will be decent divergence in performance too. So I'm looking at HCL Tech, TCS growing much faster than Infosys because they are present across the full portfolio. Infi, I think, still has to catch up in the infrastructure services side, which is about 30% of the market. So that's why I think Infosys will grow slower. They might grow sub 10% is our view.
Do you expect this to be a linear trend? When I say linear trend, there was a time when Infosys would indicate something and that used to hold true for the entire sector. Are we in for that kind of a trend for the entire large to semi-large cap IT services pack, or this is going to be differentiated where one does better, other may not do that well?
You're right. I think that there is going to be greater divergence in performance, but is it a rising tide going to lift all boats? Yes. I mean, will all boats get lifted equally? Probably not, right? So the next year is going to be better for everyone, I think. But you will see, I think, a big difference in growth rates from TechM all the way at the bottom to HCL all the way at the top among the large caps. And I'm not counting LTI Mindtree within that. I mean, I think they will grow probably even faster than all of these. But that's somewhere, it's a much smaller firm overall.
Ravi, what about the pool outside of the large cap IT pack and, their entire AI exposure theory? I mean, we've seen that long before any of Infosys or HCLTs or any have you hit a lifetime high, it was actually KPIT and Persistent, the quasi AI plays, which actually began the uptick first up.
So I think, I don't really think of them as AI plays. I think that people looking at these as, just more digital exposure in KPIT's case, which I don't cover. I mean, I think that's just a pure auto ER&D firm, and people have been excited about software-defined vehicle that they think is a mega trend. That's true, but I think the HCL talked about how they're seeing some pressure in the automotive spending, with one of the large European customers. I think that's we're starting to hear also about how EV overall there is inventory build up, and maybe some of these pens will actually be withdrawn. We heard of Volkswagen's Carrier talk about layoffs. In Europe, layoffs are so uncommon. So when that happens, it really makes the news. We are also hearing that in aerospace, Boeing talk about 10,000 job cuts. So I think in the R&D segment, there are some cuts. But outside of that, I think everything looks pretty good. And in AI, as you said, I think there is a lot of demand for data modernization and that work. We are still seeing, I think, just the early signs of the demand that is AI related. And in the mid caps, I would look at Persistent as a firm where, since it works with a lot of software product vendors, I think they are in a really good position to play a strong role. Using those capabilities, delivering solutions for their clients, even on the enterprise side.
We appreciate your time. Thank you for joining us.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.
Hyundai Motor India Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 1,865 to Rs 1,960 per equity share of face value of Rs 10 each. The anchor investor offer period opens and closes on Monday, October 14th, 2024. Offer opens on Tuesday, October 15th, 2024. Offer closes on Thursday, October 17th, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, SEBI, BRLMs and the stock exchanges.